Hey, what's happening all? Information that's hitting me. I'm getting texts, getting emails, getting calls, talking to people and say, hey, are you watching these executive orders? What the new president is doing, returning president is doing. He's going to lower interest rate. He is going to get some executive orders in place that is going to force the Fed to lower interest rates. Okay, so let's go backwards a little bit. Let's look at what's happened every time the Fed has lowered interest rates. Just look at the news. I do a Google search. Why do mortgage rates go up when the Fed lowers the interest rate? Check that out. Search that out. Because every time the Fed drops that short term rate, we're talking that's for credit cards, short term loans, things like that, that makes it easier for people to spend money. The more money they spend, the more inflation goes up. Inflation jumped every single time the Fed lowered the interest rates this last year. So three lowers every time we saw inflation jump, and every time we saw mortgage rates jump. So if our president has the capability to force rates down with the Fed, some sort of action that is taken there, and there's some, whatever political steps are taken, that will probably drive mortgage rates up because of how inflationary that move might be. Because it's going to get people spending money. And what that is when you're talking about these rates that we use for mortgages, people look at the treasury, they look at all these other things to try and figure out what's going to happen with mortgage rates. It's based on emotion. That's all it is. It's the amount of capital sitting in these pools of money to lend out. So if a person has too much capital, let's say you're an investor, you're a hard money lender, a person that you will lend money out to people. Let's just say they want they like a pawn shop, right? You're going to lend money out to folks, and you've got very few things in your shop, and you get your shop built up, right? But you want to, lend money to people so you can have things in the pawn shop to turn around and potentially sell if they don't make their payments. So, and I don't own pawn shops. I don't know enough about the pawn shop thing, but I'm kind of spitballing here. Well, if your shop is pretty light on product, you're probably going to lend people, money, let them pawn their items to you at a pretty low cost to them, just so you can get items in there and keep things moving, right? But if you're full and you don't have very much space, somebody comes and they want to pawn something, he's like, that's not worth it to me, so I'm going to hit you hard for that. Yeah, so because I just don't have the space, I don't have the need. You're going to hit them hard if they really want that, and if they want to take that, they'll take the beating on the rate that you're going to give them. Well, in the same respect, when it comes to mortgage rates, there's an enormous amount of money sitting in these pools, these mortgage-backed securities pools. It's going to be kind of cheaper because they got to get that out there and get it moving. It's not it's not good to have it sit there. If there's very, very little, then it's going to be more expensive because, hey, we're going to be really picky about where this money goes, and we're going to charge a higher rate so it doesn't get yanked out too quickly. Well, the way that supply increases is when money moves from other places and goes into these pools. Now, if you're talking about, say, the economy's doing awesome, inflation's up, people are just spending money, they're going to put the large investment capital is going to go into stock because that's where a lot of growth is going to happen. But if people are not spending money and these companies are not making money, they're not selling goods, they're not going to put their money into the stock because it's probably going to lose capital. It's going to lose value. So they're going to put it over to a long-term instrument like a bond. That's why we look at the U.S. Treasuries, the 10-year, because it's a long-term bond. But the mortgage-backed security is a separate long-term bond that they can put money into. And if it goes up, more money in there, they're going to drop that rate because they got to move it. If their money shrinks, the supply shrinks, it's going to push that rate up so people don't, take too much of the supply. So things that happened this week that may have pushed that around. Initial claims, jobs. There's a big pusher of the interest rates of where people are going to put their money, where they're going to go into stocks, bonds, commodities, precious metals, currency, wherever the big money is going to travel is going to be based upon what's happening in economies. And that's going to be done on an emotional basis on, okay, where do we think this is going to happen? Where do we feel we're going to make our return? So this week we saw claims come out, the initial claims, people filing for unemployment, that went up. It's 217,000 before. It's 223. So we saw that jump up a bit. The continuing claims, it was prior 1.853 million. Now it's up to 1.899. It's almost 1.9 million. So continuing. So that's something that's going to impact. We also have, let's look at our mortgage-backed securities. That's the one thing we always keep talking about, mortgage-backed securities. That's That's where people want to know when's rates going to go down. Trump's going to drop the rate, right? He's going to push on the Fed to drop the rate. Well, we've seen it hit us every time the Fed dropped the rate. So what we have here, see, Fed dropped the rate in September, right? Did it again in October, did it again in December. See, it's just one of these things. So this here, this block represents the day they started the value of the security when they started quantitative easing. I'll expand this out. But this block, this right here, these lines are high ceilings of resistance. It hits here before, bounces off of it. It's played in here before, come down out of it. This area here, I think, is going to be our barrier. It's like a wall trying to get through. This is after it fell from quantitative easing. We started quantitative tightening. It fell through this. And that has been a barrier to get above that we have not been able to get above, meaning the value of the security. When investors put money into this mortgage-backed security, this is where they look at as the value is the peak. This is the peak value here. We've hit that peak value in September before they lowered the interest rate, right? Created more inflation. So, and where does this all come from? So all comes from right back here when they announced quantitative easing back in November of 2008. There it is. That's the day here. Block is a little bit wide, so it's back up in here when they did that. And this line represents the end of that trading day. So this all represents one's trading day's worth of movement because of the Fed saying we're going to dump trillions of dollars into the market. So because of that, this is our barrier. So when you ask me, when are interest rates going to go back down to a normal level? This is a normal level. So if you're getting interest rates in single digits, that's a great level. We're not clear up here at the highest point of like 2023, right? We're not quite, we're almost that high point in 2022 when everybody took the massive beating from, 2% rates all the way to, 6.5% to 7% rates, actually 7% rates for the year for the people buying houses to live in. We're still in the sevens for the real estate investor. So since that is the case, and we're still seeing that, take advantage of it. And here's the other problem. If rates go down, cost of houses go up. Either way, you're paying it. All you need is to take the rate that you get and the term, and I've highly advised 30-year fix. If you don't understand why, we need to talk. Not email, not whatever, set a time to talk. 602-291-3357. Text me. And then calculate your payment, and will that asset, that business that you bought in the form of a property, maintain that expense or not? If it don't, walk away. If it does, then we need to talk more. I will go over great detail as to how you should be setting this up and looking at these deals before you move forward on investment property. If you're buying a house to live in, we'll do that too. But reach out to me, 602-291-3357, and we will chat.